Okay, everyone, and welcome to Property versus Trading interview today. So, before we start, I'm just going to show you a very quick intro about us and then we'll dive straight in. Trust you guys enjoyed that. Right. So now today the purpose of property versus trading interviews are so that to introduce you to the two asset classes of diversification to minimize your risk and increase your returns. For traders, it is to know one additional asset class that they can put their money to work further, and for property investors to learn an additional passive cash flow stream that they can possibly reinvest back into properties. Today's speaker, today we have Mark Dunsmore from Goliath Sourcing Academy. Mark was an estate agent for 10 years working for one of the big corporate firms until he realized he could achieve his financial goals working in sourcing property deals for other investors. That's when Goliath Property Solutions was born. He sources property deals for our clients all over the world using traditional and creative strategies. Now, he'll be here to share with us his sourcing strategies with you and help you achieve your financial goals. Mark, what a pleasure. Thank you for being with us today.
Hi, Terry. Thank you very much. That was a great intro. Thank you very much.
So just before we dive in much more deeper into the technical questions, just a little bit about yourself and your background. So what we want to know is, how did you first get into the world of property? How old were you when you started? What event triggered your interest? Do you do other things along with property or just do it full time?
Yeah, so I suppose really my interest in property goes way back to when I was a child. I was quite fortunate that for my childhood, we moved around a lot. We moved abroad. I moved to Brazil when I was about one, and then we moved to Portugal, where I spent most of my childhood moving around different parts of Portugal. And it's one of those childhood memories that I sort of remember going to various properties, looking at properties that had been done up, properties that were in absolute ruins. And, you know, of all the childhood memories that I've got, those really stick out to me, going around with my dad, my mum and my dad, seeing all these different houses. But obviously, as a child, you then sort of go back to being a kid and did all the kid stuff and went to school. Still kept my interest for property, but following the leaving school, I went into sort of the typical 18, 19-year-old non-university pathway, which was sales jobs. I worked in various sales jobs, recruitment, door-to-door sales, telesales, you name it, I sold it. And then really in 2005, I'd got to the point where I didn't really find sales as exciting as I once did. I was doing well. I was earning a good income, but it was hard work. You know, anyone that's ever experienced recruitment will know that it's longer than most days of working, 12, 13, 14-hour days on the phone, hammering it all the time. And that's when I got back into property, and I actually decided to 2005 get back in. So stopped everything in terms of my income, my salary. I was paid very well, and started at the bottom of the property ladder. So working as a trainee lettings negotiator when I first started. But one thing I always knew in properties, I wanted to experience all the different disciplines. So sales, lettings, management, auctions. And that's pretty much how my career then moved from 2005 until I eventually left my corporate job working as an area manager covering 11 offices in the north of England for one of the big corporate agencies. I'd worked my way up to the point where working in my career, so to speak, I realized that the higher up a career you go, the less of the doing the bits you enjoy you do. And area management ended up being quite a nightmarish role in terms of you dealt with a lot of rubbish from the top and from the bottom. And actually, I didn't do any property stuff, if I'm honest. It was just primarily managing people and numbers. So left 2014 to start Goliath. Launched a couple of businesses with Goliath, a property maintenance company working with my network, my letting agent, sales agents, and then set up Goliath Property Solutions, as you disclosed at the beginning, which was my foray into consultancy. At the time, I'd never heard of deal packaging. I still think deal packaging has been given, certain training providers have given it the label that everyone understands. But for me, it was consultancy, property consultancy, pairing property buyers, investors, even owner occupiers with property owners who I was able to offer sort of multiple solutions for multiple property problems, so to speak. Effectively, where agents didn't help, I helped. And I've been doing that ever since, and then set up the academy in 2016, helping others do exactly the same, which is just opening eyes up to the various opportunities within the property investment world.
Well, that's really good, Mark, to know that. I mean, it's always when we've interviewed traders or property investors alike and property trainers like yourself, what we found is, when you look back, the dots join together, isn't it not? Just like what Steve Jobs spoke about in his Stanford University commencement speech in 2005. I mean, if you're not gone to Portugal, that wouldn't have stayed in your childhood memories, and that wouldn't have triggered later on. And if the property management company that you worked in, if you didn't like it, then you wouldn't have started Goliath. So it's incredible when you actually look back at everything as a nice, intelligent orchestration behind everything that we do.
Yeah, 100%. I think what's interesting as well is, and I think you'll probably find this from the trading side as we find from the property investment side, is that the people that truly succeed are the ones where they fall in love with a particular way of doing things rather than being lured in by something else. So if you're lured in by money or opportunity or get rich quick or fast cars and fancy houses and big paydays, but you're not actually passionate or excited by the doing of the thing you're doing, then more often than not, you tend to see people fail or struggle or not go through the tough times. And I think from my background, there were times in my career, for example, in my agency career, where I absolutely despised the job that I was in. It was tough, hard work. The people I worked for were a nightmare to work for. But the eye on the prize was always this end goal of being an all-rounded property professional that was able to start off my own consultancy business. So it's interesting that you say that the background thing is true, and the sequence of events, the universe, so to speak, might sort of direct you in a way. But I always think that core foundation of having an excitement or a passion or an interest in what you're doing holds everything together, rather than sort of getting in on something that maybe you thought was something it wasn't, and then very quickly struggling.
So well put, Mark. I think the same thing that all of us face is just about the awareness to see, and it's quite interesting as well to see how it all leads to one another. So now getting into a bit on the technical questions over here. Is, you see, in trading, we have different type of traders. Like we got position traders who run a trade for many months and years. We got swing traders who do it for days and weeks. Intraday scalpers, just within minutes, hours, taking their profits. I'm sure similarly in property, there are different types, like investors who flip, buy and hold for yield and capital appreciation, and so many more. What would you say your main style of property investment is?
For me, I think there's a combination. I think there's an interest in longer term, so capital appreciation, so purchasing assets now that you're going to hold longer term with a view to them being worth more at the point where you plan to dispose of those. For me, there's elements of my investment strategy that includes my girls, for example. I've got two girls that are both sort of 12 and 9 at the moment. So, there's a few years to go before hopefully the properties that we have will have appreciated in value to be able to afford certain things for them, university tuition fees, things like that, giving us choices. But also, from my shorter term strategies, there's things such as refurbishments and flips, for example, that we would take advantage of when the market is right. But also sort of playing how the market shifts as we go through the cycles. So, of course, different strategies apply in different points, different periods of the cycle. And, whether I would say that I stick to any particular investment strategy, I wouldn't say I do. Apart from it being residential at the moment, and I'm looking now to go into bigger projects such as developments, new builds, that sort of thing, which I've not done before. But generally, what I'll do is leverage the experience that I've got to sort of assess where the market is at that moment in time, and then look at projects that satisfy short-term gains, so flips, for example, also potentially refinancing well. So when you refinance in a stronger market, making money when you sort of offer and get those discounts on the prices, but also make money on the added value in the refinance to hold. But then there's also, again, longer term plays and shorter term plays for cash flow. So single lets tend to be a longer term play. Our single lets have always been sort of steady, rock solid performers that don't generate huge amounts of capital. But again, like I talked about, capital appreciation is the primary goal for those. And then we've had HMOs in the past, again, which is more of a cash flow strategy. Yes, the property may be worth more in the future, but you pay more for it potentially at the purchase point. All this commercial revaluation stuff isn't something we've ever benefited from like some have in the past. It's always been bricks and mortar because we've never really gone above 5-6 beds. But the cash flow is great. So you generate a lot more cash flow, shorter term, and but that comes, of course, with transient nature of tenants, HMO tenants and the like. So in terms of one particular thing, I wouldn't say I do, but what I do is sort of assess the market at the time, look for the opportunities, use my experience, my knowledge, my sort of background, both from my own and also others when I was in agency, and then make a decision so that it's spread, I suppose, spread across different strategies for longer term and shorter term gains.
That's really good, Mark. So I guess there's quite a lot of different strategies that you're doing. Would you say that over the time you have maybe narrowed it down to maybe one or two, or do you do all of them right now?
Yeah, you tend to sort of, I've had properties in creative strategies, so controlling without owning. I've also had properties where we've owned. I've had properties overseas. And yeah, we disposed of quite a lot of our properties in 2018, 2019, just because it was a good point to gain some profit from them. And so, yeah, in terms of strategies at the time, I tend to sort of go with what's going to work at that point in the market. But I'm open to, again, with my background in agency, I think I'm fortunate in the ability to have that experience and knowledge of multiple strategies, how to deploy them, when to deploy them, how to negotiate them, how to discuss them with property owners, how to leverage my network. So I've been quite fortunate not to have to stick to one thing. However, the reverse of that, of course, is if you haven't got that experience, that knowledge, that background to be able to dip in and out of strategies, use other different strategies at different times, then it certainly is always something we recommend to our students, that you should really focus down on one thing, get really good at that, get good at understanding the cycles, the process, the due diligence, deal analysis, and then move to something else when you've nailed that, because that's going to be how you build a more consistent portfolio, rather than the risks associated with property is that the different exits you have, so the different tenant types, the different number of tenants per property, flipping to certain buyers, areas, it can lead to all sorts of problems if you get it wrong. And same as trading, I suppose. The big thing is that, and what goes wrong could be a very expensive mistake with mortgages and, you know, highly leveraged sort of assets. It's not worth taking that gamble if you can avoid it. So getting really specialist in one thing to start with, gain that experience, get a couple of properties in the portfolio, and then start to diversify through, you know, education and experience, and then start looking at alternative strategies depending on what that exit long-term goal is.
That's very good, Mark. I mean, that was good to know. I think you nailed it, right? I think in the beginning, is single-pointed focus is always critical, is always important. That's what we tell our traders and investors. I think investment principles are similar across any asset class that we talk about. Now, another further deeper question on entries. So in trading, for example, we look at retracements to enter. So for example, let me just show my screen over here. Let me just take a look so that people can have a understanding also on how we actually do it on the market. So for example, if we take a look over here, we got a very simple uptrend here, and we wait for a retracement to come back down to this price level. We don't buy it at the top, we let it come back down before we start to look to enter the position. And in this particular example, yes, we got a nice ride on towards the top. But however, very similarly in property investments, how do you guys do it? Is it more like generally value investing where you buy below market value, or is it looking at more on yield that you don't really bother about where you buy it in terms of market value, and you just focus on growth and yield strategies? Is there like a concept to everything that you take?
So yeah, there's always a plan. So there's always a strategy. And I think that you can, for example, the below market value sort of terminology that you use there, Thiru, in terms of buying at that point in the market. Now, it's a funny one, below market value, because I think that it covers a multitude of sins, and really value is interpretive. So when we talk about actual market value, it's often not what agents are marketing it for. And I suppose, similar to stocks, I suppose there's going to be areas, property types, demographics that are going to be good purchases at various stages of the market. So whilst it might look like a market's booming one place, there's another market somewhere that maybe has opportunities in it that people are failing to see, because everything's telling them how strong the market is, how nothing's able to be bought below market value or below the marketing price. And actually, there's opportunities everywhere. You just need to know where to look. So when we look at deals for ourselves, we're always looking to try and get a good deal at purchase. So whatever we purchase that property for, what we refinance that deal for is going to be quite heavily dependent on A, what we buy it for, and B, the value that we add. Now, the value that we add, of course, is if it's in a strong market and we buy in that place, well, the value add we can bring in might offset the discount that we have to buy it at, if that makes sense. However, if we can't add as much value because of the area, the property type, the tenant type, the exit, the refinance ability, then again, the importance then is what we buy it for, without heavily depending on what we add value to. And that gap in between, that spread, is ultimately what we're trying to ensure is as much as possible, so that we're not leaving too much capital in each deal that we purchase. Then the yield, of course, is important. For me personally, it's not necessarily, if HMOs are important for cash flow, so the yield is potentially more important than the discount. But again, like I've just mentioned, the purchase costs of an HMO, for example, are going to generally be higher. Or if you're buying something to convert to an HMO, the refurbishment costs are going to tend to be higher, which means that you risk leaving more money in the deal. But of course, the return on that money that you leave in is higher because of the rent rental income that you generate. But generally, I tend to be more focused on the longer term gain for single lets, for example. So their capital appreciation, like we talked about, and then anything that we buy for cash flow would obviously be yield based. But at the moment, our focus is more long term than it is cash flow short term.
Interesting, Mark. I think most of the property investors or the videos that you hear online, most people are really talking about the yield more than the longer term gain and selling it off before the thing. It's good to have that different view mind from yourself, which is a good refreshment. I think we can talk about it more further as we go on later as well. Another thing what we do want to go into is when you buy your properties, I mean, do you look into the individual property in question, or you look at the overall market conditions as well? Like, for example, COVID-19 that we have experienced and are still experiencing. I believe from a little bit from what you said, I think you do look into it, because I guess that was one of the main reasons why you sold it in 2018. So some of your properties, yeah.
Yeah, I mean, it's definitely to do with market trends. So identifying good times to buy, good times to sell. There's always deals around. So by having a very clear strategy around what it is you're trying to achieve, it means that you're looking for the trends associated with that strategy rather than generic market trends. Unfortunately, the media that most people are susceptible to will lead you down a path of thought that might make you ignore or be ignorant to the reality, which more often than not, the reality behind a certain market condition and the reported I was going to say fact, but it's not fact. The reported points of the market in the media can be very different. So I think having the experience and the knowledge of your own strategy and knowing what the market's doing, identifying certain key points, things like what's selling in the area, what's not selling in the area, the price rises, analyzing trends from the previous years up to that point. But then that said, there are also opportunities for individual deals on the basis that you could purchase something now with a view to maybe making that into something else when the market conditions are different. So you purchase it now, hold it now for little to no return. So as long as it isn't costing you money effectively on a monthly basis to run or to hold, and then with a view to then developing that further when the market conditions are right. So, an example of that might be, for example, identifying a hotspot in a place. So Leeds, for example, there might be a hotspot that's being developed, or regeneration or development. And what you're effectively doing is not necessarily betting, because you're basing this on research and your local knowledge and your specialism, and you purchase properties there. You make sure that they look after themselves, but eventually that with regeneration and then the market trends, they're going to be worth a lot more than you're purchasing it for now, in which case you are parking your capital for a little bit. You're not going to refinance it back out. You're going to roll the dice a little bit, but as long as you always break even or small profit, then it's worth taking those assessments, those judgments when they pop up.
Okay, good. So you do look at a few things. So you do look at the market trends, and I believe that the other investors we have and the trainers and that we've interviewed, they do look at that as well. Whereas I think you nicely summed up that they do look at the individual property in hand, and if you can get a long-term gains from it from the future, then they will consider that too. I mean, moving on, Mark, I mean, if there were to identify one best property investment that you've done to date so far, would you say that there is such a one, and how would you classify best?
It's really hard to say best.
I've got a few guidelines here which you can classify as best. It's either best in terms of best lesson learned, or the highest yield, or the capital earned, or capital appreciation, or highest capital appreciation. So yeah, I mean, up to you. Fire away.
I mean, there was the property we had in Portugal that we sold actually doubled in money because of the Portuguese property market booming. That was a good one, but certainly not intentional. It was more accidental. In the UK, probably we've had deals where we've agreed certain strategies to start with and then converted them to a purchase because we've sort of agreed a lease option. For example, one of our properties, the lease option was for a period of time, and then the property owner situation changed and we exercised that option and purchased it. And that property has been fantastic from a cash flow. And then again, that's one that we sold in 2018. And the profit was good, but the cash flow was great, and it sold really fast. So that was a good one. They all tend to be good. I think because of my experience as an agent, we've had tenant problems, we've had non-payment of rent issues, but having done it for so long, they've never been a challenge. It's just been part and parcel of my daily life. So I would say probably capital appreciation across the majority of purchases that we've sold has been our success. It's always been that we've bought right. We tend to have found that I don't think there's been any, apart from a rent to rent that we took on, that wasn't we took it on thinking it was something it wasn't. It was too big. So another thing from an HMO point of view, actually, that was a very big learning. Actually, we took on our traditional strategy for HMOs was never to purchase anything more than 5 or 6 bedrooms. We drew the line at 6, just because we find that that's a good size. It's a good profit margin. It's good for retention of tenants. You tend to have a good group that tend to stay longer in that sort of size property. And we took on a rent to rent that actually had 12 bedrooms, 12 bedrooms it had. And we thought, we got greedy. It was a rent to rent. We negotiated a good fixed rental with the landlords through their circumstances. And we thought it would be great. Numbers worked perfectly. The room rates were great. The potential for occupancy was high. And then the harsh reality of managing 12 separate tenants within a property. Actually, the dynamics of people, that number of people in a property was a nightmare. It was an absolute nightmare, even for someone with my experience. Just managing personalities, managing issues, managing the way that people deal with things, managing the way that people got on with each other. It was a real learning experience, that one. So not one that we've owned. That was definitely a rent to rent. And actually that rent to rent we handed back to the property owner, who eventually sold that property with a bit of advice and guidance from me with regards to how they should do it and how they should sell it. But yeah, I'd probably say, if I was to identify one major learning experience, Thiru, that would be it, that rent to rent, the 12-bed rent to rent, because I hadn't managed that many bedrooms before in my agency days, but I figured, how difficult could it be? And I realized very quickly how difficult it was.
That was really good, Mark. Thanks for sharing that. I think everyone definitely gained massive value from that one. From actually, that's what happens even in trading, right? I mean, we are used to a certain type of strategy, but then suddenly the greed takes over. And then we want to write the trade a bit more further and then make more money. And that's when everything goes pear-shaped. And nicely, as you described, I mean, one strategy that was really working for you very well was, and your rules was take a HMO of 5 to 6 bedrooms. But then you saw this one with 12 bedrooms and calculations were great. Everything looks good on paper. And then you go on the ground and then you're thrown in with things that you never expected. I mean, the exact things with any asset class investments. And nicely, you said the management was tough. In fact, I must say that one of the guys that have followed this model and have done quite well is London Shared. Am I right?
I've recognized them, but I think, are they like co-living?
Correct. Yeah, co-living. But like you nicely said as well, I don't think they ever do anything like 12 bedrooms. I think the maximum they ever do is 4 to 5 bedrooms. They convert the house, they look after it for the landlord, they give a fixed rate to the landlord, and they take the rest of the profits. But they've expanded quite a bit.
Yeah, I mean that's it. The rent to rent model is fantastic on the basis that you can keep occupancy levels high, reduce the voids by sort of maintaining, reducing churn. So you want to keep tenants for as long as possible, and you've got to try and make your property stand out, so that you're not ever competing on price, which I think is quite a big challenge for a lot of people in property investing. Is the confidence to be able to invest early to make sure that you can charge more rent than your competitors, so that you don't actually have competitors. You just have your own positioning in the marketplace as a specific type of property. And rent to rent is even more important to do that than regular HMOs, because of course ultimately where your business makes profit is how much the uplift is from what you guarantee the property owner and what you rent that property out for, and keep that income consistent. So whatever you can do to increase the value of that property to tenants, the better it is. So it is a great model. But again, like you said there, with them, that 4, 5, 6 bed model for me, in my experience, is the sweet spot. 5, 6 bedrooms is that sweet spot, with occupancy levels being consistent, values being able to charge more than the marketplace. If you make them a lot nicer, you offer certain things that the others don't. And also they're just easier to manage. And what people underestimate is that the management of these properties is, it costs, whether you associate your time with a value, which you should always, but if you don't sort of put an hourly rate on the number of hours that it takes for you to deal with a tough property to manage, you'll very quickly realize that your profit disappears. The phone, dealing with the phone calls, or even if you've got agents managing your rent to rent or your properties in general, you've got to deal with the agent. You've got to have that time, that decision making. You've still got to take on that headache because they're going to tell you about it. So you've still got to experience it and think about it. So yeah, it sounds like they've got a great model. But sweet spot, definitely 4, 5, 6 bedrooms.
Great stuff. I mean, yes, there's definitely one thing that people, underestimate is the management of people. And what would you actually then tell to people wanting to go into HMOs, even if it's 5 to 6 bedrooms? What advice would you give to them, Mark, in terms of management? Would it be right from the start, prevention better than cure, in the sense of vetting the tenants thoroughly before you even get them moving in? What would you say then?
Yeah. So what's interesting about HMOs, so any rental property, you should always vet your tenants before going into the property. With single lets, of course, you want to ensure that they can afford it, that they've got a good background, and ideally you want employer and landlord references. But with single tenants, the beauty of single tenants is that you're not dependent on them getting on. I mean, ultimately, if they're couples, they might split up and all that stuff, but that kind of reduces, the risk is minimal with single lets. Where the challenge with multi-lets comes in, with HMOs, licensed and non-licensed, is that you are managing multiple personalities. So it's very easy to rush to put the first 5 people. Let's say we've got a 5-bed HMO. It's very easy to rush to put the first 5 people that come through that meet all the criteria into that property. However, if you get the wrong sort of mix of people in your HMO, what will very quickly happen is they will start to annoy each other, or what they will become are, room hermits. So they'll basically just spend all their time in their bedrooms. And where we've experienced the best occupancy rates in terms of minimal voids, best tenants getting on with each other, least amount of management, tends to be the groups that get on with each other. So groups of friends, or groups where they move in and you've got the personality types right, where they get on. So you can move people into a property that they don't know each other, but then actually very quickly you already knew that they would likely get on, and then they get on, and then they create a home for that HMO. So Yes, you can do all the references, and you should absolutely do your reference checks, your employment references, your landlord references. But when it comes to HMOs, what's just as important is the fact that they're going to get on. Because if they get on, then you tend to find that they will stay longer. And if they stay longer, it means you don't have to keep advertising rooms. If you don't have to keep advertising rooms, you get more profit and you've got less hassle. And you tend to find that they then stay with you quite a long time, which is ultimately the best result that you can get from any investment.
Nice insight there, Mark. I think something that people cannot foresee, that tenants do not get along in a co-living and how you overcome that. That's great. Thanks for that. Now, another thing that we do want to ask is, in a recession, banks usually stop lending or they get very strict. We usually tell our trader clients to make the money of shorting the markets, which you can only do in the financial markets alone. And that's how the big movie was made as well, Big Short, where he made billions shorting the market ahead of the subprime mortgage crisis. So we usually tell our trader clients to make the money of shorting the markets and put it into property as a down payment to get their lending instead of getting it from the banks. I mean, what other suggestions would you have when the banks get strict on lending money?
I think when banks get strict on lending money, it's because what they're trying to do is protect themselves, as any financial institution would when it comes to protecting their own businesses. So when it comes to crashes or financial struggling markets with regards to property, you've got to be ready to take advantage because there are going to be massive opportunities where whilst lending becomes more difficult, it's not impossible. So what you tend to find is that the loan to values are lower, which means you need to put in bigger deposits. But because of that, then the market is made smaller to only a smaller pool of purchasers. And what that then means is that the opportunities are bigger. So you can obviously then look at taking better deals, better below market value deals. You can then make your money when you buy and then hold for the longer term. So definitely, be ready for those opportunities by having that pot of capital ready to go when those markets crash. So having a disposable pot or at least equity in other properties that you maybe already own, whether it's your home or whether it's other investment properties you've already bought, that equity is great to be leveraged during those financial crises. The other good thing about sort of financial crisis markets is that you can leverage creative strategies. So again, strategies such as lease options, where you can agree a purchase price in the future, agree it now for in the future, but then take control of the asset. So again, you can take control of those assets, you can rent those out. You tend to find that rents remain fairly stable through financial crises rather than purchase property prices. Rents don't generally go down that much, so you can maintain rental, but you are obviously going to benefit from that without actually having to purchase that property. Then when the markets start to recover, confidence starts coming back, you can exercise your option, purchase that property for the pre-agreed price, keep those tenants in or whoever it is that you've got in that property, and then build a portfolio that way, which is also potentially another option. Rather than putting in 35-40% deposits into purchasing properties, you could also leverage that across lease option strategies where you pay £1,000-2,000 legal costs to get the option contract set up, but then you've got those assets ready to purchase when the market recovers.
Okay, great tips over there for people to look into. Now, moving on into the risk management side of things. In any investment, one of the main principles is always risk, right? So we always ask ourselves not how much money we can make, rather we ask as a professional investor or a trader is how much can we afford to lose? So in trading, for example, we use very strict risk management rules and we know our drawdowns of any particular strategy before we start. In fact, any professional investor or trader will look into their peak to valley drawdown statistics and always will look to minimize it so as to almost get a linear curve, which is very tough, but that's what everybody is after. Ray Dalio's concept and advice towards getting an almost linear curve and reducing the risk largely is through diversification. In fact, he says that that's the only holy grail that we all have. So likewise, coming back into the property sector in specific, how do you guys mitigate your risk? Is it simply to see if the yield that you're producing from the rental income can cover the mortgage payments? Is it simply by looking at that, or by some other things as well?
I mean, it's definitely to ensure that at no point is your portfolio costing you money to run. In an ideal world, you will never have that issue. Now, obviously, if there's arrears and things like that, that's a separate issue. But what you want to be doing in terms of ensuring that any rental income is going to cover your mortgage costs and some. I mean, mortgage requirements require that it's 125 100, I can't remember what the percentage is now, 125% I think of your mortgage amount has to be covered by the rental income. So that in itself mitigates any sort of risk as much as you can. What's interesting as well when you said about diversification is that if you stick to one very specific strategy all the time, the way that the markets shift, if you do flips, for example, and you only do flips, there's going to come a point in the cycle where flips don't work. So you can't resell the property for the value that you want to achieve. There's not enough buyers, whatever reason there is on that exit. So you have to accept that if you're going to stick to that one strategy, there's going to be ebbs and flows of opportunity. So you're not going to be able to keep that maintained throughout the whole process. If you do buy to lets, for example, and you've got single lets, then obviously it's consistent, but you're not really gaining anything. Shorter term, it's longer term that you're playing. And depending on what that exit time is, it depends on what the market's doing at that time. So you might find that your planned exit was in 10 years' time, but actually you can't because we're in the middle of a downturn. So we have to wait until after for maybe 14 years, 15 years. Whereas if it's the diverse portfolio, diverse strategies that you're sort of doing in bits as you've gained that experience, then again, that's going to benefit you from a short-term cash flow point of view and short-term bigger pots if you're doing flips, and then of course your longer capital appreciation as well. And obviously buying at different times means that you're going to be buying at different points in the market. So obviously as the wave goes up and down, depending on what assets you bought when, they're going to be worth different amounts at that point. So you're going to be able to sort of offset any risk by not buying all your properties in one year, and just sort of doing it over time. And by doing it over time, then that in itself will mitigate any risk.
Okay, that's good. So two things I think we took from there is one is you're saying is diversification and buying it at different times as well. The timing, which is another principle in investment. I mean, the usual thing that most people say to increase your cash flow is to take only interest, only mortgage. Now, what happens, Mark, when the interest rates go up? And then I guess everyone at that point will rush off to sell. But if there are not enough buyers on the other side, then I guess you're stuck with a very highly expensive property that is actually taking the money off your pocket. So how do you mitigate that kind of risk?
So a big thing with regards to interest rates is that generally as interest rates go up, they only go up incrementally anyway. So as long as you're not really tight to your sort of margins between your mortgage amount and your rental income, then you tend to find that over time you'll be able to increase your rents accordingly, and that's going to mitigate any risk of that interest difference. So I wouldn't necessarily say that when interest rates go up, everyone looks to exit, because unless you're really highly leveraged and really close to the bone with those payments, you can offset that by increasing the rent or really increasing the rent or diversifying with that property, turning it into something else, whether it might be a holiday let, for example, or if it's able to turn into a multi-let. There's various things that you can do to your asset to mitigate that interest rate hike. But yeah, I think that what's really important to remember is that rents stay pretty stable. They only really tend to go up. And the interest rates, as they go up incrementally, you'll be able to increase that rent to protect yourself.
Okay, interesting. Okay, that's good. What kind of leverage would you recommend to be safe in most markets? Would it be the 75-25 typical or 80-20? What would you say?
Um, I suppose it really boils down to your own attitude to risk. You know, by the very nature of the marketplace on lending, you can't really get anything much better on an investment property than 80-20. So 80-20 tends to be what the banks suggest are a good level of risk. So I suppose that's something to be taken into consideration. Obviously, the higher loan to value, the lower loan to value rates means that you've got more money invested in those properties. So you potentially got more money left in deals, but obviously you've got that equity in that property to leverage against other things. So personally, I don't think there's necessarily a right or wrong answer to that, but if we take what the banks suggest, that tends to be a good guide.
Okay, that's good then. Now, in terms of adverse situations, like for example, recessions, and one of the triggers that we had was the pandemic recently. Wouldn't really still say that was a recession. It didn't really trigger off a great rush off, sell off in the markets. But even if we were to similar things like that, which caused the recession, like the Brexit or uncertainties and all that, or in terms of the pandemic, the main reason was that the main thing was the some tenants were struggling to pay their rent. And how would you overcome such risk situations so as to still keep paying and be on top to pay your mortgages as property investors?
So there are rent protection insurance policies out there that you can adopt. So you can pay monthly for rent guarantee insurance, for example. Excuse me. And in the event that a tenant stops paying rent, there are certain conditions that they must sort of go into, but generally they'll pay you the rent for as long as it takes to get that tenant evicted. And most will also cover legal costs of the eviction itself. So there are insurance policies that you can have in place to protect you against that. Alternatively, then you've got to know that there is an additional amount of income that you can afford to cover rental if a tenant was to stop you paying. So if you don't have that income to cover that rent, then yes, obviously there is a risk that that property mortgage isn't going to be paid, and then you would need to potentially have to look at disposal of that asset in order to get rid of that risk. Unfortunately, now the nature of the rental market is that it's very difficult to get tenants out. It's very expensive, it's very lengthy, and like you rightly mentioned with regards to the pandemic, even that, there were 6-month rules before you could serve notice, and then the courts were backlogged with evictions. And so as far as I would advise my clients when it comes to rent arrears, the best thing with tenants is to catch problems early. So if tenants are struggling financially, you can look at things, for example, like reducing the rent for a period of time, or offering money back at certain periods, or just giving them incentives to at least contribute something so that what you've got to cover is less, or if anything at all. So if you know that there is a big amount of rental income, that you've got a profit between the rental income and the interest only mortgage payment, for example, then you could reduce that massively to help the tenants so they feel better that you are doing what you can to help them. They feel more obliged then to pay what they can to you, and you keep your tenants happy and in the property, and you don't have to think about reletting it. You don't have to think about finding new tenants in a market that's going to be challenging. But also you tend to find that the more you do for your tenants, subject to you putting the right tenants in the first place, but the more you can do for them, you tend to find that the more amenable they are to paying less. But at least if they're paying something, then you're going to be getting some sort of income in from that.
That's good, Mark. So yeah, you're saying the more you look after them, and then of course it's the general principle, isn't it? The more you give, the more you get back, and the same principle with the looking after the tenants. That's really good. And you did mention about rent protection policies as well. That's great. Now, one more on the risk management section. I'm just looking at time as well. Just a quick one, what you would say based on the usual question that we usually have seen from property investors is, in terms of capital repayment versus interest-only mortgage, what would you actually recommend? How would you tackle that?
So we've always worked on interest only. Main reason being is that the more you can reduce the payments that you've got to make for your mortgage payments, then obviously the rental income, the more of that rental income is profit. So it makes more sense financially to operate on interest only. What you do, however, need to take into consideration is that if you're interest only, then you've still got that full amount to purchase that property at the end of the mortgage term. More often than not, most people really think about disposing of those assets in order to get that. Again, we just go back to the point that I raised a little bit ago about the market. So if you are at a point where your mortgage is coming to an end, your interest-only mortgage is coming to an end, and you're in the middle of a dip, a recession, a crash, then trying to achieve the value that you need to achieve for that interest, for the capital repayment amount, may be a challenge, which then also means that at that point, are you able to get another mortgage? Potentially not. And you could face all sorts of trouble then, which you don't really want to do. So hopefully, if you've held onto that property for long enough, the cycles will mean that the property is going to be worth more than that. So, but it's a risk that you have to bear in mind. But like I say, most investors that I know of, that I've dealt with in the past, and also from my own personal viewpoint, is really we would aim at some point to dispose of those properties. So, if again you're identifying trends, you're looking at what the market's doing, you're identifying potential risks. Well, actually, like we did a couple of years ago, same principle. We didn't know a pandemic was coming, of course, but and actually, ironically, we probably would have done better holding on to them, but it doesn't matter. We were basing it on a market cycle risk analysis for us, and we got rid of our properties on the basis that we didn't want to be left with them in what we were believing was something that was coming, which still could be coming, but we aren't going to have to worry about that. And we're in a position now to take advantage of any downward trends that do potentially come, but also any any deals that appear in this market, we can take advantage of as well.
Interesting. So you're saying that maybe usually only interest-only loans. Yeah, I think that's something I heard in another thing is that most people should do only interest-only loans, especially for high cash flows and all of that, and dispose it at some points. But they did also recommend paying off 10% of the capital every decade as well. I think that is something that maybe people can look into as well, based on how risk averse they are.
It certainly takes away that risk of the future issues, like we mentioned with the downturn. That definitely would get rid of that.
Coming on to nicely, I mean, you're talking about at some point you dispose properties and looking at the risk factors and everything. So coming into that, we go on to the next part, which is the exit criteria. Do you have like predefined exit points, or do you buy and hold it forever? Do you have a time range to define your exit points? Because in trading, we have predetermined targets based on open equity or adaptable targets according to price velocity or open equity data that we gathered. So likewise for property, do you have that or?
No, in short. So I think we tend to base things on the market. We base things on our own personal position in terms of whether we want to dispose, need to dispose, want to invest in other projects. So it's more about having the asset with a view to then being able to have that option to do certain things at certain times. Of course, we keep an eye on the markets. We look at trends. We look at the cycle. We look at tenants. We look at the legal system, in terms of how difficult it might be to evict tenants, for example. So now with our own personal investment strategy, we're not looking directly at private tenants anymore. We're not looking at single let tenants, HMO tenants anymore. We're actually looking more down the route potentially of holiday lets because of the transient nature nature. They're not protected in the same way that the private tenants are, and it's become an increasingly difficult market. I think I've got quite a unique position on that I've had it for many years. 17 years of looking after tenants is enough scars for one person to sort of reconsider that strategy. But in terms of disposing of the assets, it really is a case of, there might come a point where we need some capital, so we'll dispose some of the portfolio in order to raise that capital. It might be that we've identified a trend that we believe is a risk to a certain property type, a certain demand, a certain tenant demand. It might be that there is a demand for people buying those properties who are prepared to pay a premium compared to what we believe we might get again in the future. So it's about keeping your finger on the pulse rather than having like a considered exit date or a plan, or hold it for 15 years and then look to dispose. It's more about taking each year as it comes, assessing what the market's doing, what's going on underneath, what legislation changes are there, what development opportunities are there, what things can we get involved with that we want to do, and then looking at the portfolio and then doing what we want to do with that as and when the time comes.
Interesting, yeah. So it's more to do with the market conditions and on the spot reassessing the risk, and also if you want the capital to reinvest in other big trend markets that are starting. Then just a quick add on to that question. So in global meltdowns where the recession lasts for 2 years, of course it'd be wise to liquidate some properties, before the recession starts, ideally, even though most people would just have only hindsight to actually praise upon when they look at. But let's say the recession lasts for 2 years, it'd be wise to liquidate some and to buy others later for cheaper prices for your money to work harder. As such, do you have timing factored in your investments? For example, cycles usually is about every 8 years, 10 years, we get a recession. So do you have timing factored in?
The timing does come into it. You do sort of keep an eye on things. The timings are getting longer between cycles. So, where cycles might have come around every 8 to 10 years, now it might be every 12 to 13 years. So you've got to keep an eye on that, because you could dispose of your properties too early if you just went on the basis of historical cycles and then find that the market was still going up for another 3 years before it corrected itself. So it's about, like I say, keeping a finger on the pulse, speaking with the experts who know. I'm not a financial expert. I'm not a mortgage expert. I'm not a financial advisor. But I have financial advisors and mortgage experts and wealth advisors who are in my network, who I sort of keep speaking with, who will identify certain things that might suggest something is going to happen. And if we look with hindsight at all the previous crashes, there were signs, there were plenty of signs, and it's easy with hindsight to spot those signs. But equally, there's certain people pre all of those things happening that were also suggesting it way before they happened, that they were going to happen. And I think that what you've got to do is you've got to be careful, because you've got to take some stuff with a pinch of salt these days. There's a lot of fake news. There's a lot of people that have very strong opinions on something based on just opinion. But by bringing your experience in with sort of that of other people, and identifying certain triggers that might suggest that the market's crashing or about to crash or going to correct itself, if you are able to at least identify certain things like that, you can be prepared for what might happen. Now, none of us can predict what's going to happen, but some are better at guessing than others, should we say. And if you can get those people in your network and have those conversations and be realistic, then actually very quickly you start to identify. And it's the same not just for downturns in the market, but it's also the same for trends, investment opportunities, all the things that you want to catch before it becomes talked about publicly, is generally what it is. The minute it makes mainstream news, it's almost too late. So if you can catch stuff before the mainstream news by sort of leveraging the people in the know, generally I think you'll give yourself a good chance of understanding what might happen. And you might get it wrong, but ultimately, if you didn't get it wrong and you got it right but didn't do what you wanted to do, you could be far worse than kicking yourself that you didn't make an extra 10,000, 20,000 on your property.
I think awesome. I think, Mark, I mean, the main takeaway from that, especially for all the audience listening in and also those who will be looking at the recording later on as well, is that, it's your network, right? Your network that you build and keep talking to others so that you keep ahead of what is about to come and what is happening. In fact, they say two things got the deepest impact in your life. One is the books that you read and the people that you know. And I think you nicely nailed that. And I think continuous financial education is always critical and always important to keep ahead of news and to take the precautionary measures before we get a big upturn. Now, you see, in terms of the last part is I'm just looking at time, maybe just 5 minutes maximum. I mean, in terms of psychology and all that, with trading and other investments, 80%, especially with trading, I mean, because it's so fast and quick, one of the main things is 80% of trading is actually psychology. So we traders, we do a lot of work on the mind to keep our mind focused and be on the present moment. Like that, I mean, in terms of your property investments, in terms of keeping your mind in focus and towards keeping a healthy mindset, is there any practices that you do that keeps you focused and ever creative?
I write a lot of stuff down. So I always think that we, as humans, we've always got a lot going around in our head. So what I tend to do is I write a lot of stuff down. If I've got ideas, I use Evernote. I don't know if you know Evernote, the app. But
Yes,
Evernote's
Evernote, yeah, it's good.
yeah, it's a great tool, and I've got it on my phone. I've got it on my desktop, and basically, anytime that I've got ideas, thoughts, I just dump it into the Evernote app, and then I sort of go back and look at it, which keeps my mind free of noise for when I need it to be clear. But I tend to just be. I like listening to audiobooks. I like reading books. I've got lots of books that I use as reference. I don't tend to read books cover to cover. I tend to go and read sections of books when I need to read sections of books. I very much focus my energy on what I need to understand right now. So, if I'm doing a certain thing, then I know I need to revise a certain part of it. I go and look for that content online with my books and audiobooks specifically around those things. So it means that I'm not getting too distracted with everything else that's sort of floating around. But in terms of any sort of mindset thing, I think what's interesting with property a lot of the time, a lot of it is experience. You've an experience that yes, you gain from education, you gain from sort of learning the basics, but you never learn as much as doing. And a lot of the learning comes from doing the viewings, doing the negotiations, speaking with people, and then a lot of that comes with confidence. And I think confidence comes with going into things with the right attitude and the right mindset of not worrying about failing. I think a lot of us worry too much about failing. And I always think, we never fail, we just learn. We do something, it doesn't work, we learn from it because we don't go and do that again. And as long as you remember when you're doing things in property, and I'm sure it'll be with trading as well, is that it's all about making sure that when something does go wrong, which it inevitably will do because it's the nature of life, that you don't ignore it and forget about it and sort of push it to one side. You embrace it, you understand it, you learn from it, you take the positives from it, and then next time it happens, you know it won't happen again.
Nice sentence that you summarized there, Mark, is that you never fail, you always learn. I think if we can keep remembering that, that will help us all go much, much forward in our journeys. In fact, the same principles in trading or in any investment as well. So, Mark, we've come to the end part of the interview. So if people want to find out more about you and learn more about you, because you're running out of time now, where would the right place be? Where can they go out to find out more about you?
So you can go to goliathsourcingacademy.com, goliathsourcingacademy.com. You can also go to markdunsmore.com to look at a bit more about me personally that's not Goliath related. And I would absolutely be more than happy to connect on LinkedIn as well. So if anyone wants to connect on LinkedIn, you could find me on there, and it would be a pleasure to connect.
I believe it's this one over here. I've also put in the chat box for those of you listening in and for those of you going to listen to the recordings later as well. This is the website. Am I right?
That's correct.
Yeah.
Yeah, that is.
So, and if they want to like learn, like, do you do like newsletters or anything that they can keep on top, or they can opt in just to learn more about you?
Yeah, absolutely. So the way that we actually do it is you can, if you find anything that's of interest. So we've got the blog on there. We've got some good, so the get started as well. If you get started, there's some real good guides on there. And you can sign up for any of the lists from those links. So anything that you want, there's free downloads in there. Sign on that, you'll get added onto the newsletter, which is our mailing list, and then you can stay up to date with everything that Goliath.
Okay, that's great. I guess they've got all the information there that they need to continue on with their learning experience. I believe if they have any questions at all, they can just type it in as we're showing them this as well. And in terms of property investors who want to see if trading is for them, of course, we've done a quiz over here, which I've also put into the chat box as well, that you guys can give it a go. It takes less than 60 seconds. You will know what your trader type is, which is also cross-transferable to any kind of trading or investment. I guess we'll just give it a few minutes for them to see if there's any other questions coming in, Mark. But other than that, I mean, any last points that you want to pass on to the audience over here and the people who are going to watch the recording?
Just that, as with anything with regards to additional revenue or job replacing sort of plans, to make sure that you're getting into the right thing for the right reasons. I think more often than not, it's very easy to be lured into Facebook ads and Google ads and, promotion of free events that entice you into get you excited about certain things that you may not have considered before. I just want people to really think about, is it the right thing for them? Are they doing it for the right reasons? And, are they going to be, excited and passionate about it? Because the road will inevitably be a rocky one. It will have its challenges. It will have its learnings. But if you're interested and you're excited by it, you'll tend to find that you get through those quite easily. If it's something that you do because you've been told it's a way of making money or a way of leaving your job, but you don't find it exciting or passionate about it, or you have any sort of interest in it, then the journey becomes 100 times harder. So just make sure you're doing the right things for the right reasons. And, I wish everyone every success.
Thanks a lot for that, Mark. It's such a pleasure having you on board today on Property versus Trading interview. Thanks for your time, and thanks to everyone who have come in. And as we always say, till the next time, stay disciplined, follow your trading plan, and keep trading like a master. Thank you, everyone. And if you want to find out more about Mark, as I've already put in the chat box, go on the goliathsourcingacademy.com. I think that's all pretty much that from us. Thank you so much for your time again, Mark. And everyone, bye from us over here. Thank you. Take care.
Thank you.
If you want to get notified every time we put a video up, especially on our live trading update videos, hit the subscribe button and turn on the bell notifications icon. This will get the YouTube algos to kick in and for you to join us in our mission to spread the truth of trading further, so that traders like you can benefit from our videos, to trade like a master, achieve consistent performance,